What if the world's most important weapon isn't a missile or a microchip, but a $1 trillion IOU? Picture a midnight skyline in Beijing, a team of officials in a glass-walled war room, eyes fixed on a glowing map of global money flows. Across the Pacific, in a Washington, D.C. bunker, Treasury staffers track every move, every rumor, every bond auction. This isn't science fiction. This is the reality of the 21st century global economy. For decades, China has quietly amassed over $1 trillion in US Treasury bonds. To some, it's a strategic lifeline, a symbiotic relationship that fuels America's spending, keeps China's factories humming, and ties the world's two superpowers together in a complex embrace. But to others, it's a silent weapon, a financial nuclear option that could shake the global order with a single massive sell order. So what happens if China decides to call in America's tab? Who really needs whom in this high-stakes trillion-dollar chess match? Today, we're diving into the secret history, the power plays, and the financial war games shaping our world. Stick around to discover how this all began and who truly holds the power. To understand how we got here, we have to step back in time. It's the late 1980s. China is just beginning to open its doors to the world under Deng Xiaoping's reforms. This sparks a tidal wave of factories, exports, and ambition. Soon, massive container ships are leaving ports like Shanghai and Shenzhen, packed with toys, electronics, and affordable clothes, all destined for American shelves. As these goods flow out, American dollars flow in. Billions at first, then hundreds of billions. China's trade surplus with the US explodes. This created a new problem for Beijing: what to do with all those greenbacks. In the country's financial ministries, a critical decision was made. They wouldn't spend the dollars on lavish projects, and they wouldn't convert them all into gold or euros. Instead, they would buy US Treasury bonds, America's safest, most liquid financial asset. The logic was simple, yet brilliant. Buying US Treasuries helped keep the value of China's currency, the yuan, relatively low. A weaker yuan made Chinese exports even cheaper and more attractive to American consumers. This, in turn, kept those American consumers spending, fueling the very demand that was powering China's economic miracle. It was a perfect, self-reinforcing cycle. America got cheap goods and a willing lender to fund its deficits, and China got jobs, growth, and a mountain of secure assets. By the late 1990s, China's foreign reserves were swelling to unprecedented levels. The Asian financial crisis of 1997 served as a stark warning to the region. Currencies could collapse almost overnight, wiping out decades of progress. Vowing never to be caught in such a vulnerable position, China doubled down on its strategy. It began building a massive financial war chest, systematically recycling its export dollars straight back into US debt. Then came 2001. China officially joined the World Trade Organization, and the floodgates opened. Its exports to the US and the rest of the world soared to unimaginable heights. By 2008, on the eve of the global financial crisis, China's holdings of US Treasuries had ballooned to nearly $1 trillion, making it America's largest foreign creditor after Japan. Wall Street traders and government officials alike began watching Beijing's every move. A single rumor of a Chinese bond sale could send shockwaves through global markets. This new dynamic was so significant that economists coined a term for it: Bretton Woods the Second. It described a new global financial system where America borrows and consumes, China lends and produces, and the entire world spins on this delicate and increasingly tense balance of power. It is the story of how a nation went from deep poverty to becoming the world's biggest creditor in just a few decades. But as China's pile of American IOUs grew, so did the risks and the potential for leverage. The relationship that once seemed purely economic began to look more and more strategic. The question that lingered in the halls of power in both Washington and Beijing was no longer just about economics. It was about control. In this intricate financial web, who is the spider and who is the fly? The answer is far more complicated than you might think. It continues to shape the geopolitical landscape we live in today. Picture this. It's 2008. The world is on fire. Wall Street is in a total meltdown. Lehman Brothers has just vanished, and the global financial system is grinding to a halt. It feels like the end of the world. But behind the scenes, an unlikely hero steps in to help keep the lights on: China, with its massive trillion-dollar pile of US government debt. While the Federal Reserve was frantically cutting interest rates and firing up the money printers with something called quantitative easing, China just kept buying. They were snapping up US Treasury bonds like there was no tomorrow. It was a classic marriage of convenience. America desperately needed someone to buy its debt to fund its recovery. China, flush with cash from its booming export economy, needed a safe place to park its mountains of US dollars. And what's safer than US government bonds? This bizarre, intertwined relationship got a nickname: Chimerica. It was a partnership built on mutual need, but also a deep-seated mutual suspicion. For a while, it worked. China's purchases helped keep US interest rates low. which meant cheaper mortgages and car loans for Americans, and it funded the government's stimulus efforts. But in Washington, the alarm bells were ringing. Politicians started warning about a debt bomb. The big question was, what if China decided to sell? What if, with the press of a button, Beijing dumped its trillion-dollar holdings? Could they crash the US dollar, send interest rates soaring, and plunge the world into an even deeper depression? This wasn't just an economic question. It was a national security one. The power to disrupt the US economy was sitting in the hands of its biggest strategic rival. Of course, the reality was a lot more complicated. Chinese officials had their own nightmare scenario to worry about. They were caught in what became known as the dollar trap. If they sold their US bonds too quickly, the flood of supply would crash the price. They'd be destroying the value of their own investment. It was like holding a financial grenade. They were too invested to get out without blowing themselves up. They couldn't sell, but they couldn't stop buying either. Behind closed doors, the debates were intense in both capitals. In the US, some saw China's holdings as a crucial lifeline, stabilizing the system when it needed it most. But others saw it as a dangerous vulnerability. In Beijing, the sentiment was similar. Some saw it as a smart investment, but a growing number saw it as a noose, tying China's economic fate directly to America's unpredictable politics and spiraling debt. The entire world was on edge, watching every bond auction, every central bank statement, searching for any hint of a shift in strategy. A single headline could move billions of dollars. This was the central paradox. What happens when your biggest customer is also your biggest rival? Then came 2017. The uneasy truce shattered. The US, under a new administration, slapped massive tariffs on Chinese goods, igniting a full-blown trade war. Beijing hit back with its own tariffs. Suddenly, the world's two largest economies weren't just competing. They were in an open economic conflict. The fight was no longer just about trade. It was being fought with spreadsheets, sanctions, and financial leverage. Back in Washington, the old fears resurfaced, but with a new urgency. Politicians started talking about financial weapons of mass destruction. The idea of China dumping its treasuries was no longer a theoretical risk. It was now called the nuclear option. In Beijing, war rooms were running simulations. What would actually happen if they pulled the trigger? Would it cripple America, or would it backfire spectacularly, destroying their own reserves and causing global chaos that would hurt China just as much? The US didn't wait to find out. It began to wield its own financial power, tightening sanctions on Chinese tech companies like Huawei, blocking investments, and even threatening to freeze assets. The message was clear. If you weaponize your dollars, we'll weaponize ours. In response, China quietly began to change its strategy. It started to slowly, carefully reduce its holdings of US Treasuries. It wasn't the dramatic dump everyone feared, but a gradual diversification. They started buying more gold, more euros, and pouring money into their own global infrastructure project, the Belt and Road Initiative. The era of Chimerica was officially over. The financial lifeline that had once held the world together had become a tool of war. And the question that everyone was asking was no longer if the two giants would clash, but what would be left standing when they did. Every rumor of a debt dump sends shockwaves through global markets. Bond yields jump, currencies wobble, investors scramble for safety. It's a threat that feels both immediate and terrifying. But is this standoff a real threat, or just a high-stakes bluff? The emotional tension is real. The panic of 1929, the brinkmanship of the Cold War, the uncertainty of every modern crisis, each moment feels disturbingly similar to today's standoff. Could China crash the dollar with a single sell order? Or would Beijing be the first to drown in the flood? Step back and look at the world's financial chessboard. This isn't the first time debt has been wielded as both shield and sword. In the 1980s, Japan was America's biggest creditor, buying up treasuries, skyscrapers, even Hollywood studios. The fear then was of a Japanese economic takeover. Decades before that, OPEC nations, rich from oil, threatened to dump dollars for gold, challenging the very foundation of the post-war financial system. More recently, Russia, flush with reserves, tried to insulate itself from Western sanctions by diversifying away from the dollar. Each time the world held its breath. Each time, the system bent but didn't break. But China's position is unique. Never before has a rising power held so much of a rival's debt while competing for global influence, technology, and resources. It's a symbiotic relationship, but a deeply fraught one. The US needs China's capital to fund its spending. China needs the US market to fuel its economy. They are locked in a financial dance where each partner could trip the other, but doing so would mean they both fall. The threat is double-edged. If China sells its US debt too fast, it risks a global panic and a collapse in the value of its own remaining assets. If the US pushes too hard, it risks losing its biggest creditor and shattering the trust that underpins the dollar's dominance. The risks are eerily familiar from history. A sudden sell-off could trigger a global panic, spike interest rates, and shatter confidence in the dollar. Imagine your mortgage rate doubling overnight, or the cost of imported goods skyrocketing. That's the potential fallout. But the costs for the seller are just as real. No one wants to destroy their own fortune, or the system that keeps their factories running and their people employed. So, is this the world's most dangerous lifeline, or a weapon no one dares to use? What did past debt standoffs teach us that today's superpowers can't afford to forget? The emotional echo is clear. Boom versus collapse. Stability versus chaos. Gold versus fiat currency. The interests of a dictator versus the lives of ordinary citizens. The lesson from Japan, OPEC, and Russia is that unwinding these deep financial ties is incredibly difficult and self-destructive. The global economy is too interconnected. Pulling one thread can unravel the entire fabric. So, what does the US-China debt standoff really mean for you? It is more than a headline. It is a warning about the hidden weapons and fragile lifelines that shape our world. Every crisis, every negotiation, every rumor of a debt dump is a reminder that the rules of global power are being rewritten, not just in parliaments or on battlefields, but in the bond markets and digital ledgers of the 21st century. History shows the cycle. Nations rise on credit, build empires on trust, and sometimes fall when that trust is broken. The Panic of 1929, the oil shocks of the 1970s, the financial crisis of 2008, each moment feels disturbingly similar to the tension between Beijing and Washington today. The question we must ask is this: will the next global crisis be fought with dollars, not drones? Will the next superpower win with a spreadsheet, not a sword? The answers are hidden in the past, if you know where to look. We dive deep into these questions, exploring the cinematic economic history that defines our present and future. Subscribe for more and learn how to navigate the next global reset.